The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Well, good afternoon to you on this Friday. Great to be here with you. I'm Nadine Blayeny, and this is The Call. 10 stocks picked by you, 2 expert guests, all in the space of 60 minutes. Now, we've got quite the list here that we'll be going through today. Let me get you through the first 5. We'll be talking Harvey Norman. We'll be talking QBE Insurance. John, if you're out there, we'll be speaking about base resources for you. And Brickworks is also on the list, considering it did report just the other day. That'll be an interesting one to discuss. And Latitude Group holdings for Gareth. Gareth, I hope you're watching or listening. We'll be getting there in the next little while. But I'd like to get the stock of the day under our belts as per usual at the top of this program. Now, I'm just checking my screens because when I was keeping an eye on the market in the first hour of trade, we did have Computershare as the best performer. And that is, of course, because we are in a rising interest rate environment. If we know anything, we know that this week. The FOMC hiking rates by 75 basis points for the 3rd time in a row. We have Jerome Powell saying that he's going to keep at it in terms of rising rates until inflation gets brought back under control. 6 central banks through the overnight lifted rates as well. So the outlier really is the Bank of Japan, or we could say the Bank of Turkey, which cut rates, believe it or not, through the overnight period, even though inflation there is running at around 80%. So the question is for the stock of the day, would you be buying Computershare? And to help answer those questions and more, we're joined here in studio by Philip Pepe from Shaw & Partners. Wonderful to see you. And remotely, Junbei Liu from Tribeca Investment Partners is joining us as well. So look, Philip, I'll start with you on the stock of the day Computershare question, because you have to be thinking about the macro when you're investing these days.
Absolutely, and days like today highlight just how fearful people are of further interest rate rises. And yes, I think Computershare is worth a buy despite its recent strong share price movements. They put out very strong guidance with their full year result for earnings per share up 50%. Now, a lot of that is because of the interest rate rises that they knew of at the time, and some of it is to do with their recent corporate trust acquisitions. They face some cost headwinds like many companies do. They are an IT heavy and labour intensive corporation, so those cost pressures are going up. But despite that, they put out a 55% EPS guidance, which may well prove to be conservative. Last financial year, about 10% of their revenue was interest income, but that's about 35% of their profits. That'll increase materially into FY23. They've got about 38 billion in cash and investment balances, and they're flagging 520 million in margin income. That's a material increase on PCP. So that's a very good, that alone is a reason to buy QBE, Computershare, I think. Yep. Yeah, CPU, absolutely to buy from me.
Okay, wonderful. We've started out this program pretty strong with a buy from Philip Pepe from Shaw & Partners. Junbei, I think we've got you there. What do you make of Computershare given the inflationary and interest rate environment that we're in now?
Share price can move very, very quickly. Now, for Computershare, at this point, if you put the spot bond yield, interest rate, future predicted interest rate in, it is probably come about 20 to 30% upgrade compared to consensus numbers. So for me, investors need to follow earnings. If the earnings is going to be upgraded by that much, share price certainly heading higher. And another point is, this company, as Phil touched on before, never used to make so much out of the interest margin, and now suddenly it's a big part of their earnings. And this company would generate so much cash flow just from those extra margins that they make. And that cash flow, at this point, market hasn't really considered what they're going to do with it, because they can use those to buy accretive businesses. Now, whether market will like it or not, it certainly is going to be very accretive using those excess cash flow that they previously didn't expect to have to reinvest into a business. So all of that are very positive for this company, and it's absolutely a buy at this point.
Double buy to start this Friday edition of The Call. Great to have you guys here with us. Great, because you've known each other for quite a few years as well. So that being said, Philip, if you disagree with something that Junbei says, and vice versa, Junbei, don't be afraid to do so. All right, let's get to the companies
Will do.
that have been put forward by you. And here's an interesting one to start the conversation, being Harvey Norman. This is for Terry. Terry, thanks for writing in. Remember, this is information only. This is not advice for your specific personal circumstances. But Harvey Norman, so we're talking about inflation. We're talking about rising mortgage rates. We're talking about a weak consumer. Junbei. We bought a lot through the pandemic. Does Harvey Norman still have some upside left in it?
Look, I think Harvey Norman will be in a tough place in the next 12 months. I think the earnings still looks very strong, as you touched on, and the next 3 months to 6 months perhaps still looks okay, but certainly going forward on a 12-month view, it's looking increasingly tough. One is, like you said, that we bought so many things before, and two is that consumer will be going through a little bit tougher periods, and at the same time, the housing cycle is turning somewhat. So you will see reduced turnovers, and that reduced turnover simply means reduced volume for furniture. So, Harvey Norman will be in the tough phase in the next 12 months. And it's just the wrong point of cycle of owning it. I will be selling the stock at this point, and just as the earning will need to be rebased.
Okay, so we've got a rebasement of earnings in Junbei's perspective for Harvey Norman. But, it's got property, doesn't it? And it's got diversity in terms of geographical exposure. I mean, if you think about not just here in Australia, but overseas as well. I mean, are there any positives when it comes to Harvey Norman?
It does have the properties. I think it's a sell, by the way, because I think the positives are in the price. Mm-hmm. And as Junbei said earlier, share prices tend to follow earnings, and consensus has got about a 15% per annum decline for the next 2 years. So that's some strong headwinds to fight. It's hard for companies to outperform in declining earnings cycle. If you look at the trading update it gave for the first few months of this financial year, Australia's doing well. I think Singapore is doing well, parts of Europe. Canary in the coal mine, New Zealand struggling. So there are regions starting to struggle. And if you look at the latest ABS retail sales data, home goods are one of the only ones to decline in July, so we're starting to see things cycle off a high base. They clearly benefited from the work at home, stay at home, buying more technology to use at home, buying white goods, etc. Property prices high off. I mean, you trade up in terms of your furniture. Those earnings are now coming off a high base. At about 50% of their earnings come from Australian franchisees. So, despite being diversified, they are still quite reliant on the Australian consumer, and weaker, strong headwinds in terms of interest rate rises and property price reductions, cycling strong comps in some of their categories. I think Junbei is right to be cautious, and it's not expensive, but it's not cheap, so it's probably easy ways to make money. So it's a sell from me in the near term. Because
there's opportunity cost, right? Yeah. If you hold on to something like Harvey Norman going into this slowing cycle. And it's interesting you bring up the New Zealand experience, because of course they're ahead of us in terms of their interest rate hiking cycle. So okay, that's a sell coming from both of our expert guests today. Let's get on to the next company. Again, a household name, so I don't really need to introduce it. QBE Insurance. This is for Tim. Tim, thanks for joining us. Now, Philip, I'll start with you on this one. Is this yet another one of those companies that does potentially stand to benefit in a rising interest rate environment? Is that enough for you to be a buyer of QBE?
I think it's a buy for two reasons. Firstly, it's an insurance company, so it collects premiums, which it uses to pay claims, but it gets to invest those premiums in investments and largely cash and fixed interest securities. So they will definitely benefit from rising rates because they have an investment portfolio which will directly benefit one for one. I think it's about 10% of their gross written premium was investment income. That will grow going forward as rates rise. But they've also done a good job in improving their profitability, particularly in the US. They were making a loss in the US a year ago. They delivered a 7% insurance profit margin pre-interest in the latest results. So they're improving their profitability. Their outlook is conservative. They've guided for their December year end, they've guided to 10% growth written premium growth despite delivering mid-teens in the first half and adding to provisions where they could have been releasing. So I think their first half results were conservatively stated, chance for some upgrades in the second half, plus the benefit of interest rate rises. So I think there's multiple reasons to own QBE, and it's not expensive at the current price, so it's a buy from me.
Buy. Junbei, would you be buying QBE earnings upgrade cycle? That's when you would like to buy. Do you sort of agree with Philip on his assessment of the real tailwinds for the company right now?
Absolutely. Look, this company is in a really good spot at the moment. They have had a really tough many years, and when they had all the excessive claim across the crops and things, and then just in the last few years, we've started seeing the commercial rate start improving the right way, and the commercial rate has been reasonably strong, actually quite strong in the last 12 months. And then going forward, we just went to US and saw some of their competitors, such as Traveler, and they talked to the commercial rate continue to be increasing in the double digits. So that's actually going really well. And for this company, that's very important. And then aside from that, invest income and everything else. So, look, this business is in a good spot at this point, and it's defensive because it's an insurance company, and then it's not as expensive. And if you compare this stock, QBE tend to be used as a macro stock as well, a bit like CPU, it actually, in terms of performance, has lagged other sort of similar interest rate sensitive or sort of rate sensitive sort of stock. So it does place it in a pretty good value bucket. It's a buy.
It's a buy. It's another double buy. Our investment committee is going to be busy this time around. Jimmy, just picking you up on that, I mean, is now a time to have some defensive names in the portfolio?
Look, it's always important to have defensive, and I think at this point you do want to have probably more of them. Now, defensive doesn't mean holding more cash or anything else. It's about buying company that has earnings that's not linked to the economic cycle, because we know the cycle is somewhat slowing, and some markets is slowing faster than the others, and then we've got this inflation that hopefully has peaked in some markets, but markets like ours probably still going higher. So all of that uncertainty ahead, you want more defensive characteristic within the portfolio. So you want to own companies that earnings doesn't require economic activity to be red hot. So things like healthcare normally sits really well in that kind of bucket.
Got it. Thank you. I can see Philip nodding as well. So we'll get on to the next company, because this one is potentially not a household name. So this is Base Resources. BSE is the ticker code. This is for John, and I like getting a bit of context as well. So thanks for that, John. He's holding it. So he already owns some of it. So he would just like a view on Base Resources. So this is a mineral sands producer, I do believe. Yep, so it's a producer, not just an explorer, but it is producing in Africa when it comes to these mineral sands. Philip, do you know the company?
I know a little bit about it. We cover the mineral sand space, and we like the space. This company is interesting. It's paying a dividend, which is for a mining company of their size, 350 million market cap. It's quite impressive. It's producing a lot of cash. Mineral sands are used for things like paints and plastics and other household goods. We like it as a space. The concern I have is their current mine, which is a good one, ends 2024, so 2 years to go. They have plans to expand into another mine in the region, and they've got guidance out there, or consensus is, for another 700 million in capital expenditure over the next 3 years. So you've got a 350 million market cap company planning to expand in an interest rate rising environment, needing 700 million in capital expenditure in the next 3 years. So how are they going to fund it, at what price, etc. So there's concern to me that there might be a capital raising at some stage, or a big debt raising, etc. A related company in the US overnight called Chemours, which is listed, which makes titanium-based products, which is also used in paint and plastics, etc. Put out a pretty negative trading update saying demand for their products, particularly in Europe and Asia, have fallen, have weakened. So similar but not the same, and their share price has fallen off. So if the thematic is coming off and the company's planning an expansion, spending twice its market cap, that's reason to be cautious. So maybe now the time to take some profits. I'd have it as a sell until they tell us what they're doing with their capital expenditure over the next 3 years. So it's a sell for me based on short-term thematics and big capital raise, or big requirement for capital versus their current market cap.
Got it. Yeah, Jumei, did you have to do a bit of digging, excuse the pun, for this one?
That's right, absolutely. Look, I absolutely agree with Phil. In terms of mineral sands, I think the outlook is it is a little bit tougher. And just when you think about the paint is used for finished houses and finished products. So it's a late cycle cyclical, they call it. So right now we're seeing the housing market has been really tough in China for the last little while, and it's going to be a little bit tougher further on. So China has been a big consumer of that, and is going to we can see early indications of that's going to come off. So outlook doesn't look great, and then you see the housing market around the world is sort of cooling off as well here in Australia also. So in 12-month time, demand will be pretty tough. So and that is a space that you do feel they have had a bit of hot air. The share price has performed quite well. So I'll be taking profit at this point.
Yeah, okay. So there we go. Take some profits if you've made them, John. Thanks for writing in. And I think that dovetails quite nicely, Junbei, with the next company on our list as well. This is Brickworks, BKW. This is for George. So Brickworks was out with its result just day before yesterday, day before the holiday, I think it was. It was a pretty solid FY22 result. It's an interesting one because it's obviously leveraged to the housing market, the housing cycle. I remember speaking with the CEO, Lindsay Partridge, ages ago, right when housing prices were going gangbusters, and he had flagged the fact that you were going to see a lot of smaller builders go bust because he saw that inflationary pulse really coming. So I suppose the question is, when it comes to Brickworks, is it too, Junbei, really exposed to this slowdown in housing, or is the thematic here in Australia, where we continue to need to build, we are still short on supply when it comes to housing? It does have property play itself as well, and it's got an overseas business. So how do some of those parts add up for Brickworks for you?
Yeah, look, I've always felt Brickworks is as almost a conglomerate. Is a little bit confusing as what it means for an investor. It's a company that's been around for a very long time. A lot of time it's been purchased by investor as a dividend yield play, and then with a bit of property play as well. And the most recent result, it had a good result. The property sale was very strong because they had a big pipeline, and they sort of all came through, and the result was very good. However, going forward, that we are seeing that the forward indicator for housing perhaps will be weaker, but the pipeline is very strong at this point. So I do think, even the housing market may come off a little bit because of the backlog. Remember all the supply chain issues and things. We will have a bit more activity extended, as we have heard from the CSR. We have heard a couple of other material companies. So, these extended activity will still be there. So for this company, look, they will have a reasonable earnings, but not looking much growth. I think next year's earning might be a little bit tough just because the property earnings is, one-off in nature. You can't really capitalize on that, and then they don't have the big pipeline that's coming through in the next few years. So for me, it's I wouldn't be holding it, but if you hold it, it's a 5% dividend yield. It's not expensive. It's a business well managed. It's been managed for many years. It's probably a hold.
Got it. Hold from Junbei. But to Junbei's point, not expensive. What do you think of the price of Brickworks?
It's probably close to fair value based on analyst forecasts, but for me it's a buy, because it has been listed for a while. So one of the more interesting parts of their presentation, I thought, is for the last 54 years, they've delivered 12% per annum returns to shareholders. Oh, really?
So that's not a bad track record?
Not a bad track record. So it's long enough to give them the benefit of the doubt. Interest rate rises are a headwind. But it's more diversified than people realise. They publish their NTA, which is about $30 per share. About half of that is Solpats. So the interest rate rises are a headwind, but it's more diversified than that, and it's got a long-term track record of delivering through the cycle. So with a $30 NTA, I think share prices in the low 20s, there's a fair big margin for error. So for those who do think longer term, I think it's a buy on a long-term basis, despite there might be some volatility in the short term. The company's delivered for 54 years. It's a good bottom drawer stock, for want of a better phrase.
Wonderful. And we'll be speaking with Lindsay Partridge again. I believe it's Tuesday, 9 o'clock, if you'd like to tune in. We'll put it up online as well. So before we get to a little bit of a pause in proceedings, let's get to number 5 on the list. This is Latitude Group Holdings, LFS. This is for Gareth. Am I allowed to call you Phil, or do I Junbei calls you Phil. Okay. Phil, over to you. Latitude.
It's a sell from me.
Okay.
It's the sectors in the Nordic order in the Simbin. Interest rate rises are one-for-one cost increase for their industry, for them directly. It takes a while to put rates rises through, but the cost increases are borne up front. They've seen volumes come off to flat, failed M&A with Hum, sort of gone astray. So where's the growth going to come from? The headwinds are obvious. It's a tough. So I think consensus has not a lot of growth coming in. It's just not a sector you need to play. And this company in particular hasn't really delivered in the last 12 months, so it's an easy avoid for me.
Yeah, because it's not long listed, of course, and that is not Junbei. I don't know if you can see it there at home, but it's not an attractive looking chart. It's been a bit of a pain trade for people who bought in at the IPO, which we should say was, it was delayed. I mean, it took a lot to get this company to market in the first place.
Oh, absolutely. It took a couple of years, I think, a few goes, and I was surprised I actually managed to pull it off. So the share price chart certainly has gone the wrong way. It's meant to be from one side to the other.
Yeah.
Essentially, this is a consumer credit business. Now, you don't want to buy a consumer credit business in a slowing consumer environment. So for two reasons, right? So first reason is that two reasons. So first reason is that your overall volume is facing a bit of tough time because people are probably buying less things, and so that your volume will drop. At the same time, perhaps consumer might be lower end consumer who probably use a lot of those products might be under a bit more pressure financially given the mortgages and cost of living. So your default, your loss rate might start going higher. And for those companies that are very sensitive to to what those loan loss ratio will be. And at the same time, as Phil touched on, that the cost of borrowing is higher. These guys are not the bank. They don't generate the credit. So they will have to borrow it from the bank, and the bank has already put up prices. So they sort of stuck in the middle that their margin really will get squeezed during this period. And depending on how bad our consumer might get to, it may be okay. But regardless, profit going backwards in this environment, and you just don't want to buy a business when the earnings going backwards, in the current market environment.
Yeah,
it's a sell.
Yeah. Okay. So we've got the two sells for Latitude. All right, we are at the halfway mark, so Junbei, I'll let you have a sip of water. Phil as well. I'll sum up what we've learned so far. My notes are an absolute disaster today, but I do know that Computershare is a double buy, so both my guests would buy. It's generating a lot of cash. Now, Junbei says it could look to buy businesses with that cash. Regardless, Phil says that, look, it's got very strong guidance going forward. So there you go. Harvey Norman. It is a sell for both of my guests. It's just in a tough place right now as consumer sentiment wanes. And Phil says, look, it's fully priced. There's better opportunities. It's a sell. QBE, it's a buy for both of my guests as well. It's a defensive name in Junbei's view. Also, look, Phil says that it's looking to improve its profitability. Don't forget, it's exposed to investments in the bond market, so it's a buy from both of my guests. Base Resources. So Junbei calls this a late cycle cyclical company. So it's a sell for her. We're seeing slowdown in property markets. That uses some of the mineral sands in some supplies that are used in the property market. So that could be a bit of a negative for that. It's also a sell for Phil because he says that it's planning to spend up big time in the next few years. It's a red flag. How are they going to fund that big CapEx project? That's a sell. John, if you've made any money, try to cash it in. It's only money on paper, I guess, until you sell. Brickworks, it's a hold from Junbei. She just thinks it's a tough environment going forward for any company that's leveraged to the property market. But Phil has some confidence in management. He says, look at its track record. So it is a long-term buy for Phil. And Latitude Financial Group, look, they're both selling. They just don't see any reason to be in that space right now, just in general, not to mention that Latitude has had a pretty tough go of it since listing. So we have a couple of contenders for this high conviction fund that we track here at ausbiz. It's picked by our investment committee. If you'd like to watch it, you just have to go to ausbiz.com.au, and at the top there's a tab that says series, and you can go to investment committee there. Here's an update on the portfolio. So as we look there, you can see still holding about 10% cash. We've got Universal Store, NextDC, Lottery Corp, ResMes, and Saunders Minerals all out at the last meeting. But we have a lot of action. We put Karoon Energy, Boss Resources, Washington H. Soul Patts, Premier Investments, and South 32 into the portfolio, which is up by 1.4%, let's call it that, on a cumulative return basis since its inception on the 1st of March. So how it works, you send your questions into us on this program. We put them to our guests. If it is a double buy, we put it to the investment committee. If it's a double sell, we also put that to the investment committee. If it's a company that's in the portfolio, and say, what do you want to do? So we will look forward to adding, well, QBE and Computershare to that next conversation.
The Last Call is brought to you by AVL Wines. Invest in the home of Australia's premium wine, spirit, and ready-to-drink cocktail brands.
Welcome back to the program. This is The Call on Friday, September the 23rd. Wonderful to have you with us now or listening later, which I know a lot of you do, to the podcast version of this program. So coming up next, we've got Servcorp for Pat. We've got Coles Group coming up. Ragusa Minerals, RAS is the ticker code there. I think I've said that right. Boral and Saunders International, which is SND for Perry. So let's start, shall we? Servcorp, SRV is the ticker code. This is for Pat. No context as to whether Pat is a buyer, currently a holder of this company. So Jumbe, I'll start with you on Servcorp. I know UBS said that it delivered a very solid result last time around, came through at the upper end of guidance. Operating conditions, though, you would think are challenging for Servcorp, considering what's going on in the broader economy and office space.
Yeah, absolutely. Look, it's tough because, especially here in Australia, many people have yet to return to the office 100% of the time. And, there's also structural changes about how, flexible working condition and places where people can work. Certainly, it's earnings recovering, and the expectations for the stock for the next 12 months is not very high. It's not expensive. But my view is that, look, if I want office exposure, I will be going out to buy the likes of Dexus, also very, very cheap, but number one top tier, top tier office space around Australia, trading at a big discount, I think something like 15-20% discount to NTA. If it stays that cheap, you'll probably will be taken private at some point. So, so for me to gain exposure to offices, which is not exciting space, I'd much rather to buy the more premium space, sort of office space, rather than where Servcorp is operating. And also for that Servcorp's marketplace, there's a lot more competition now coming through. If you look around, some of their properties are getting a little bit dated, and the competition is actually, quite strong. So, so for me, I wouldn't be holding it. I would sell it. And if I want office exposure, I will be buying Dexus.
But just sort of reading between the lines there, Jumbe, it sounds like you're not, Dexus, you'd be a preferred pick in this space, but it doesn't sound like you're rushing out to buy Dexus either.
No, look, property trust is very difficult at this point. They all have a lot of debt. To remember, high interest rate means the debt is going to impact their earnings. All of these companies probably means won't have much earnings growth. If anything, most of them will be earnings downgrades. Now, depends on how the contract is structured. So the retail centers, such as Center Group and the like, they have a straight inflation pass-through. So something like 80-85% of portfolio has inflation pass-through. So at least that can hedge somewhat with high, to offset the high interest rate. Whereas offices, it depends really contract to contract. So so office space, the property trust space is going to be tough just because of the high interest rate.
Okay. Do you agree with Junbei's sentiments about the sector overall, and then specifically Servcorp?
For the sector, yes. For Servcorp, absolutely not.
We've got some disagreement happening here, finally.
Strong buy, Junbei.
Strong buy.
Strong buy on Servcorp. For the exact reasons that Junbei mentioned, not to own it. Servcorp is a flexible office space provider, and it actually facilitates working from home that many people don't realise. So let me address one thing, 90% of their revenue is offshore. So a lot of people get preoccupied with what's happening in Australia and Victoria, where we're still working from home. Not the case overseas. Our government subsidies meant that more people could stay at home. Where there weren't government subsidies, people are back to the office more frequently. Servcorp offers 3 to 12 month leases that you can bolt on an office as you need it, you can take it off as you need it. But they offer a service, a virtual office package, which means you can have a Barangaroo address, you can have your mail and phone go through Barangaroo, but sit in the suburbs working from home, but look like you work in the city and come to the city when you want. That is one of the reasons why their profits, they turned a profit during the lockdowns, because a lot of their customers were working from home anyway. They just didn't come to the cities as often as they wanted. A lot of the research put out by the global property companies, that is the new norm. People want hybrid workspace, and a lot of them are converting floors into more flexible offices, trying to compete with Servcorp. Despite the competition that Junbei mentioned, a lot of those companies are bleeding money. One of the more famous ones is WeWork, which, despite being a market disruptor, despite pricing aggressively, is losing over $1 billion US per annum.
Not only that, but WeWork is very different than Servcorp.
Very different.
Like Servcorp, you can sort of, even if you are in the office, you have your own.
Yeah.
You could think that you're just in somebody's regular office.
Correct. So Servcorp, for example, has a presence in this building, which is a tier 1 building. So Servcorp will offer a quality building access to the small to medium-sized enterprise who can't afford to take out a whole floor on Chifley Tower or number 1 Barangaroo, number 3 Barangaroo. The WeWork were more cheap and cheerful. You're sitting in a coffee shop with your laptop. Yeah. You're now sitting in a WeWork office with your ripped jeans and a t-shirt. Whereas Servcorp has always targeted lawyers, bankers, accountants, those who actually need to be in an office. So they have never not paid a dividend, their entire listed history. And we talk about exposure to cash. They have 110 million in cash, no debt, zero debt, and 20% of their market cap is generated in free cash flow each year. The company would probably be taken out by private equity or a bigger competitor if the managing director wanted to sell. He owns 51% of the company. He's not selling. It's on 9 times PE, 6% dividend yield, spits out a lot of cash. It is the new norm, or what they do is the new norm. For me, it's a strong buy, because demand for traditional office space is declining, but serviced offices is actually growing stronger.
Junbei, has he convinced you?
Look, actually, it sounds pretty good, but I must say that it does sound pretty good. But I must say that, for this company, they had a tough few years, and for them to really continue to grow and take an opportunity of changing working condition, they do need to spend in their office space. I myself have visited quite a few Servcorp office, as well as a couple of new ones by a number of new competitors in the market. You do need to refresh and spend. So that's one point. And the second point is, I absolutely agree. The work environment is going to change. It's no longer about sitting in front of a desk. It's about collaboration, the collaborative working environment. And I do think a lot of large, office property trusts, they're so well capitalized, and they are not going to sit still. I really think some of those new offices that's been built in the future is going to accommodate that new working environment. So, just on that basis, I do think that competition is coming. It's important for this business to keep spending and keep growing and be innovative about what they could do.
Right. Good. Okay. So there we go. That's what makes a market, isn't it? So strong buy coming from Phil, and we've got still Junbei sticking with her sell on Servcorp. Let's go to Coles Group, shall we? We know it. Many of us go there ourselves, sometimes more than we would like to. I feel like I'm at the grocery store every second day. I don't know why. But regardless, look, they're thought about being really defensive names, Woolworths, Coles in a downturn. But is that actually the case this time around? Because we're coming out of such an extraordinary period, being the pandemic. Junbei, do you consider Coles a defensive operator, a defensive potentially part of your portfolio?
No, I think it's like, look, supermarkets, they're normally defensive, as in people have to visit supermarket every day or once a week and buy certain amounts. But remember, these guys, as you said, has been a huge beneficiary of people staying at home. Now, Coles is because of their a lot of their centers are actually more city driven. So with people working from home, their earning actually somewhat was impacted compared to the likes of Metcash when people were all working out of suburbs. Supermarkets, people have over-indexed with supermarkets, and they have now benefiting from high inflation as well, because they're pushing through price increases. Normally, you actually see the margin grow for Coles and Woolworths. The share price has come off, and however, next 12 months is going to look a little bit tougher, because if you look at the margin, the fresh food sort of inflation is already coming off. So probably another good quarter of inflationary numbers for these guys. And then secondly, that consumer probably will return to work and going out to perhaps restaurant for some time rather than cooking at home. So there's a lot of headwind coming through in the next 12 months. For me, it's probably a neutral, because if the share price come off, it's not as expensive compared to Woolworth. Woolworth is still very expensive. However, I just think facing consumer slowdown environment with the company over indexed with what they've been earning, it's going to be a little bit tougher.
Okay, to Junbei's point, Phil, I bought a lettuce yesterday, not at Coles, but at a competitor, for $1.70. Just proving that these prices will retreat. We're not going to be looking at food inflation. They've got to pay energy. They've got to pay their staff. How do you see the outlook for these big players, particularly Coles?
Look, I agree with Junbei. The food suppliers definitely benefited while we were all working from home, and in some cases definitely benefited from food inflation, which is starting to come off. What isn't coming off is logistics costs, electricity costs, etc. So you think some headwinds there. The only advantage I'd give them over, say, Woolies is the perception that they are the cheaper offering. So as consumers look to trade down certain items, more household goods, more cheaper version, more cheaper experiences. Yes, there's Aldi, but versus Woolies, they may pick up some market share versus Woolies, which will make them to some extent defensible. But the stock is priced fairly attractively, so I wouldn't say it's a sell, but it is a hold, only on valuation, given that its outlook is pedestrian. Consensus isn't forecasting a lot. It is the cheaper of the two. So if you had to own it, you'd own them, but it's a hold at best.
Yeah, Junbei, just to clarify, that was a hold for you, correct, was it?
That's right, that's a hold.
Okay, we've got a hold for Coles. Nothing really in either one of those responses to shoot the lights out or get us too excited about Coles. You know what, one thing investors, at least Aussie investors, seem to be always really interested by is lithium. And so that's the next company on the list, Ragusa Minerals, RAS is the ticker code. This is from Melissa. I don't know a lot about the company. Junbei, I know you guys have a team there that looks at commodities quite closely. What's the team saying about Ragusa Minerals?
Look, actually, our team, this one seems to be very early stage, yeah. And it's in the whole exploration space, and certainly in the current environment with the volatility about macro outlook, certainly I don't want to be exposed to a very early stage exploration company. Just looking through, on Bloomberg, what it says. So explore gold. Look, share price gone up because exploration company, if they come up with any new finding and it's positive, you certainly will see spike like this. But remember, it is very, very difficult, costs a lot of money and a lot of disappointment to get to actual sort of production for most of the businesses. So for most of those production companies, pre-production companies. So it is very risky. I wouldn't be touching it, and much rather to be, invest in established producing businesses at this point.
Yeah, because Phil, I think to Junbei's point, we're spoiled for choice really when it comes to a lot of these lithium explorers. here in Australia, but we do have producers. I mean, why wouldn't you as an investor just stick with the producers, save yourself a bit of pain of that whole process of, you know, exploring and getting, you know, things into production?
Depends on your appetite for risk. So you tend not to get those sorts of price moves on those already producing. The risk junkies like the pre-production companies. What concerns me about this stock is that move was largely based on an announcement they put out on the 11th of August where they put out a feasibility study update, which really moved the share price, and then they got a please explain from the ASX about the share price move. We've seen before in lithium stocks, it often takes longer than people think. Costs often are greater than people think. So when you see a share price move like that off one announcement, of not a lot of volume for a market cap this size, I would be taking profits and switching into something safer. If you've earned those sorts of returns on a specky like this one, I would take profits and move on to something else. It's a sell for me based on that was a big share price move off an okay trading update, but still a long way to go to profitability.
Is there any lithium company that is preferred in your view?
I don't have a preference for any. It's it's a good long-term thematic, but personally, no, I don't look at the space.
Got it. Thanks. So that's Ragusa Minerals, Melissa. Do hope that helps. And then we get to sort of well-worn ground with Boral being the next on the list. This one is for Mary. Again, Phil, I can't help but think we're going to be able to avoid talking about cyclicality in terms of Boral.
Yeah, if you just look at the earnings, what they've delivered and the outlook, you're tempted to think of it as a sell. Downgraded twice into the last financial year, hit by weather issues in New South Wales and Queensland where they couldn't get the products out the door. Cyclicality, interest rate rises, etc. They're trying to put prices up. Price rises don't always stick. It's tempted to think you don't need to be there, but then they've got a major shareholder who owns 70% of the company, who bought it at a higher price, and you always wonder what are their intentions and what can they do, given that their major shareholder is also on the board as the chair. So if it wasn't for the presence of someone who could perhaps step in and change the future, I would say the stock is a sell, but I'm going to call it a hold because near-term outlook not great. Consensus is forecasting, okay results, not great results. A lot of headwinds, but with a 70% shareholder there in Seven Group, they might become 100% in a year's time if the share price continues to fall. So for me, it's a hold because of the competing pressures.
Okay, Jubei, would that be enough to make you hold or potentially even buy Boral? I mean, is it looking cheap, or, considering it had 2 downgrades, I think in the second half? I mean, would you ever buy a company like this that's in the midst of a downgrade cycle?
Yeah, look, would I be buying it? No, I'll be watching it for some time. I would, if I have it, will I sell it? Probably it's more in that whole territory, simply because it has had a really rough time. All the rain is not great for Boral. They used to say every time when it's raining, Boral is ready for another downgrade. So something like, one day rain is costing $1 million or something like that. So, look, it's really tough for them to go through. And they have had also, just a lot of very challenging environment. In terms of material price increases, they try to put price increase through, but it doesn't stick. So even though with such shortage, it doesn't stick. So it's a very commoditized space, and it's really about being larger, the bigger, and trying to drive efficiency. Now, put that aside, that's why its share price where it is today. Now, I do rate Vic enormously, and he took over Cleanaway many years ago, and he really turned around Cleanaway. And now that he has joined Boral, which you've seen on the day of announcement, share price went up close to 10%. But because a lot of investors share my sentiment, so we do think that he will potentially be able to help this business to turn around, and that's why I'm saying you probably want to wait and see, but to rush out buy, probably no hurry, because we still can see rain pretty much every day, and and then the environment hasn't got any easier for this company.
Yeah, and the Vic that you're referring to is Vic Bansal, who was the CEO of Cleanaway. So particularly when we are facing all of these headwinds, management becomes even more important, doesn't it? I mean, management's always important, but you do need to have a very strong management team, ability to execute through cycles. right now at this point in time, correct, June Bay?
Absolutely. I think especially for top business like this one, it's a industrial business that is have a lack of pricing power, and so all it needs is actually to drive efficiency. And Big has done the same thing to Cleanaway many years ago. So it does give a future investor a huge amount of confidence about what he could do. But he just got in, so give him some time. But I do think absolutely important.
Okay, so that's a hold, but it's a watch. There could be a time for Boral Mary. Saunders International, SND is the ticker code. This is for Perry. I think I've had a conversation with you about Saunders before, Phil. Yeah, you know it very well. So just enlighten us all.
I like it. It's a buy for me. It's an engineering and construction company, so it builds bridges, builds fuel storage tanks, builds roads, etc. So it's exposed to a non-discretionary spend sector. Every year the governments will spend on infrastructure. Yeah. So it's not consumer driven, it is government spending, and we can't spend enough. For example, fuel storage is an area they focus on. We import about 90% of our fuel. If there's a world war, where do we get our fuel from? We might get some blockage, we might see fuel prices hike. Who would have thought that might happen? The recommendation is for us to have 90 days worth of fuel storage. We've got somewhere between 50 and 70 days, depending on usage. We might run out of fuel. So there's over $1 billion in government spending and defence spending to get more fuel storage in Australia. Saunders build fuel storage tanks and has been winning contracts over the last few years. New South Wales is an ageing country. We have a lot of infrastructure that needs to be upgraded. For example, our bridges that connect country to city, a lot of them made out of wood, a lot of them are dilapidated. There's $500 million in what's called the Fixing New South Wales Bridges projects being allocated to upgrade our infrastructure. Saunders is winning their fair share of those contracts. So there's a lot of work out there. Their work in hand has doubled over the last 12 months to $192 million, but they have a tender book of over $1.3 billion, which is up 30% from December. So the amount of work is growing. There's a finite number of companies that can do it. None of them can get staff, so margins aren't falling. They've all got cost pressures, but the ultimate customer, the governments, the Defence Force, you just can't get staff. So there's no discounting going on to win these contracts. So you'd think there's a good 2 to 5 years of predictable earnings for the sector, and they should benefit from that. It's on 5 times EV to EBITDA. We like the space, we like the company. We think it's a buy.
I think you just answered my question, but whenever we talk about these companies winning contracts, we talk about margin compression. So you do not think that because it's such a competitive landscape that Saunders International will have to sacrifice margin?
So they've increased their margins over the last 3 years from EBITDA of about 4% to 7%. So it's actually gone up. The way they've done that is the industry stopped discounting because costs are up for everyone. So there's no point in discounting a contract and then finding you don't have the labour to deliver it. The ongoing dialogue the contractors are having with their ultimate customers is saying, we can't provide you the work this month. We need 12 to 18 months, and by the way, it's going to cost you. Things like input prices that can vary per day. The quotes the companies are giving these days are valid for a week because commodity prices change. If your decision takes longer than a week, it gets repriced on Monday. So they're passing these the prices through before they take on the contracts. So margins are steady. They probably have stopped going up, but they're not going down because we're at full employment. So you don't need to discount to win more work when your capacity is full. You keep your book full for longer is what I'm seeing at the moment.
Interesting. All right. Saunders International, what's your view, June Bay?
I must say, I love this program because every time I always learn something and find a company I never looked into before, and it looks very interesting. Now, this company, absolutely, I'm with Phil. It seems to have been around for a long time, very good track record, very strong pipeline, which means visibility for earnings is very, very high. So pretty much with the sort of pipeline that they have in the to come, next 12 months earning revenue is pretty certain. And very strong balance sheet. They can continue to make bolt-on, and industry environment is favorable, and it doesn't look like margin is looking pretty stable. So on that basis, I think it looks pretty attractive. I will be a buyer.
We've got another double buy to finish this Friday session of the call. That's fantastic, guys. Look, I just would like to end with a more general question about markets and strategy right now, because, you know, after the week that we've had, there's lots of people out there wondering what sort of strategy to sort of use toward the end of the year. Junbei, are you of the view that we could see further falls coming through, at least at the index level, between now and the end of the year? If so, how is that sort of helping you form your decision-making process about what to buy and when?
Look, from now until probably end of this calendar year, we probably think the equity market will probably more sideways trending. You will have a lot of volatility simply because we will have interest rate. Federal Reserve will continue to put up the interest rate, and our RBA will continue to follow, and our inflation will continue to grind higher, and it will not even peak for Australia. So all of that together means that earnings, it will be uncertain moments. Now, for me as an active investor, I love that kind of environment because we can short the companies we think the earnings are going to be challenged, or the sectors that have issues, and then we can buy our favorite companies that that the structural leaders that they expected to deliver growth for the portfolio. So so this environment is actually really, really good for active investors, but it just got to be very rational and following where the earning might go. And don't go with, I think this market is very important not to trade with sentiment. It's almost, you need to be a little bit contrarian in the current market, because because of the volatility, can lose return quite quickly if you started following the trend, following the herd, and that trend can reverse very quickly. So stick with fundamental, focus on stocks, and then the return opportunity is enormous. Focus on those really quality companies.
Yeah, and as an analyst, Phil, I mean, there must be, and that's the thing, is that we do get really caught up, and I'm not saying it's not natural, but in the share price falls that we see happening on a day-to-day basis off of macro headlines. But the reality is there must be good opportunities emerging as well.
Agree. I mean, you get days like today. We had a public holiday yesterday, which didn't help.
Yeah.
But we're down heavily because of some US interest rate rises. But some of the companies we've discussed today have put out pretty strong earnings updates for the next 12 months. So I agree with Junbei. Markets will probably go sideways for the range of the year with a lot more volatility. And you'll get days like today where the baby might get thrown out with the bathwater, and it'll throw up some companies who aren't negatively impacted by interest rate rises, aren't negatively impacted by a weaker consumer, but they'll be sold off almost in proportion, and they'll present good long-term buying opportunities. So if you're watching, and you probably need to watch more carefully at the moment than you have historically, it's a good opportunity to pick up good long-term buys. They might fall before they go up, but if you pick a good company, like we mentioned one that's delivered over 10% per annum over 50 years, if you get an opportunity to buy something like that cheaply, buy it, put it in the bottom drawer, you'll be happier in 3 to 5 years' time.
Got it. Thanks, guys. Now, I'll just recap what we've learned in this past half hour or so. So this is one of the few points of contention between my two guests today. It is a strong buy, Servcorp, for Phil, but Junbei is not attracted to it, even though I think he put his case forward quite well. She was listening intently, but yeah, not enough to convince her to buy Servcorp. She's got a sell on that. It is a hold for both of my guests when it comes to Coles Group. Nothing to get too excited about there. Ragusa Minerals, Phil would be taking profit, so it's a sell if you did benefit from that recent announcement that did see that significant uptick in its share price. Junbei, she just agrees it's too difficult in some of these early stage explorers. Doesn't matter what the commodity is. She says avoid it, don't touch it. Boral, it's a watch and a hold for both of my guests. Junbei says there could be a turnaround coming. It will take a long time to execute. No need, in the words of Phil, to go out and buy this now by any stretch of the imagination. But Saunders International, this is a buy from both of my guests. Phil knows the company very well. You heard his case there. And Junbei, well, it's so nice to hear, Junbei, that you still love doing the call after all this time. We love having you on board with us. Junbei, thank you so much. I hope you have a really good weekend. We'll speak soon.
You too. Thank you for having me.
And also Phil, my new friend, I'm calling him Phil Pepe from Shaw and Partners. Philip, thank you. Appreciate you coming in as well. That was a really good program. And thank you for watching. Don't go anywhere though. We've got a buy, hold, and a sell in the small cap space coming up with Claude Walker from A Rich Life. Stay with us.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.